And then we'll put you on YouTube. Oh. Okay, we're good to go.
This is the meeting of the City of Salem and Salem Urban Renewal Association Finance Committee. I'm Tom Anderson. I'm a counselor and I'm a chair of the Finance Committee. And could the other counselors announce themselves, please?
Sure. Virginia Stapleton, Ward 1.
Trevor Phillips, Ward 3.
Jose Gonzalez, Ward 5.
That's perfect. You guys did it just the way as seriatim in the order of the wards. And by the way, my ward is Ward 2. I call the meeting to order. The first item on the agenda is approval of the minutes. Do I have a motion to approve the minutes?
So moved.
A second. I'm looking at you, Ward 3.
Second.
All right. Is there any discussion? Let's call the roll.
Counselor Stapleton,
Aye.
Counselor Phillips,
Aye.
Counselor Gonzalez.
Aye.
Counselor Anderson.
Aye. The next item on the agenda, and I'm sorry, I'm looking over here because I had a hard day in my paying job today, and somehow I have misplaced the printed copy of the agenda today. So I'm looking over there. It's not that I don't want to look everybody in the eye. The next item is public comment. Kelly, is there anyone of the member from the public who wishes to comment on this meeting?
No, sir.
Okay, so now we move to action items, and it sure looks like we have no action items. Are there any action items, Josh?
No, not this evening.
Okay, so then we go to management update and information items. First one is policy C-7 investment review. Who's going to do that?
And if we could, I think we'll just kind of lump them all together if that works for you, Counselor Anderson.
That's absolutely perfect. So we will look at 5.8, small a, small b, and small c.
That's right. And I'm actually going to turn it over to Ginny Matichek, our chief accountant. She's been working with Kelly and Anya on the investment policy update and review. So go ahead, Ginny.
Okay. So as a follow-up to the July 2021 meeting, the finance staff, we reviewed the city's current investment policy and compared our policy with several other Oregon municipalities in which ethical and environmental standards are incorporated. Findings from that review can be found on the staff report included in today's agenda packet, which is under agenda item 5A. We've also engaged in conversations with the city's investment advisors, PFM, who agreed to join our conversation today. So thank you to the PFM team for your support and willingness to participate today. So PFM is going to be providing an overview of their services, a market and portfolio update, and then provide an overview of the ESG policy services they offer, which we believe speaks really well to the conversation that was had about our investment strategies. So if there aren't any questions, I would go ahead and turn it over to, I believe, Lauren Brandt, who's the managing director. And if you wanted to follow along with their presentation, it's item 5B on page 23.
Does
Great.
anybody have any further questions before we turn it over?
No question.
Okay, so go ahead and take it over, man on the phone. Lauren?
Well, actually, this is Lauren Brandt, and I sincerely apologize. I'm trying to get my video to work so you can see my face and follow along. But I do have two of my other colleagues on the line, and I'll be introducing them as well. First of all, it is so nice to have the opportunity to speak with you all this afternoon. The city is a very highly valued client of PFM's, and we appreciate our partnership with you. My name is Lauren Brandt, and I'm a managing director at PFM. I'm also head of PFM's.
Excuse me, Lauren.
Yes. Sure.
I'm taking a personal moment as the chair to apologize to you because I heard Warren, and I know the difference between Warren and Lauren. So take it over, woman on the phone.
Thank you, Mr. Counselor. I appreciate that. So yes, my name is Lauren Brandt, and I have been with PFM for 25 years and have been the city's engagement manager since 2012. I also have my colleague Allison County on the phone. She has worked with the city as well since 2012. She's a client manager and has been with the firm for 15 years. And then you heard Dave Reeser talk a little bit earlier. He is joining us today. He's not a normal, I would say, part of the city's engagement team, but he's head of our ESG group. And so we know the city's had a lot of questions about ESG, environmental, social governance policies. So Dave is joining us today to talk a little bit about that. He's also a managing director, and he's been with the firm for 25 years. So I'm just going to, because we haven't had an opportunity to speak with the Finance Committee in some time, we thought it'd be helpful to talk with you a little bit about, just give a very brief background about PFM and our relationship with the city. So on page 26 of your packet, just a very brief overview. PFM, we're actually a nationally recognized firm that specializes predominantly in advising and managing assets for state and local governments. So we're very attuned to the importance, of course, of putting safety first, and you know, especially given the implications of taxpayer funds. So safety is paramount. It goes, it's right at the very top of our philosophy in managing assets, including those for the city. We manage, speaking of managing, we manage over $170 billion of assets nationwide and over $60 billion in assets in California, Washington, and Oregon. On page 27, just a little overview of our our engagement team here at the city. So here you can see my face until I can actually get my computer to work, and also other members of the city's engagement team with PFM. As I mentioned, Allison County, and also Bob Cheddar. Bob Cheddar has been the city's portfolio manager since 2012, and our colleague Jeremy King, who helps with just all sorts of things in relating to the city and helping us manage the relationship. So in addition to the four of us, there are 250 other professionals that help us out, anywhere from those in the portfolio management team as well as our accounting group. So we have a lot of resources at our disposal for the city. And so on page 28, just very briefly, we have a lot of things that we've accomplished together, meaning PFM and the city over the last 9 years. I think we've produced a lot of good outcomes and great results together. And some of those achievements have been, again, as I talked about, first and foremost, the safety of the city's assets. So preserving the assets, even through the most recent market volatility that we've had here, as of, you know, certainly as related to COVID. And we've achieved this through employing only high quality investments and utilizing those in the city's portfolio, as well as diversifying the city's portfolio in order to preserve safety. We've been flexible in terms of adapting to changing market conditions. It's been a great partnership with the city, and the city's helped us be flexible in terms of managing your assets. And as a result, we've helped to generate some strong returns for the city, generating additional earnings and income that you can use for your projects, for other operational needs, as you see fit. So that gives you a little bit of background of PFM, the team that works with you and staff, as well as some of the things that we've partnered with over the last 9 years. And I am going to turn it over to my colleague, Allison, to talk a little bit about the recent portfolio, what's transpired over the last quarter, some of the current market themes, and then we'll invite Dave Reeser to share some more insights about ESG, managing to an ESG strategy.
All right, thank you, Lauren. Yeah, we want to skip to the next page. So I'll just provide a brief market update, as Lauren said, covering what's been happening in the economy, what's been happening with interest rates, all to provide some context on, what's been happening in the city's portfolio. So as you're likely not surprised to hear, COVID-19 continues really to overshadow the economic and interest rate landscape. Everything from supply chains that we're hearing so much about recently, to the labor markets, and then to interest rates really continues to be impacted by COVID, and more recently that recent spike we had in cases, which now we're happy to see are coming down. The economic recovery, since the big hit we took in early 2019 has been quite strong. For the past 3 quarters, quarters ended June 30th, GDP has been well above where it was pre-pandemic, and the most recent 2 quarters, the quarter ended March 31st and the quarter ended June 30th, were above 6% GDP annualized growth rate, which is just very impressive growth. And the consumer has really been the driver of the recovery. The Federal Reserve has also helped to spur growth with their accommodative policies in place since March or April of 2020. That includes purchasing $120 billion a month in longer-term treasuries and federal agencies, and keeping their Fed funds target rate at a range of 0 to 0.25%. Both of those policies are in place to keep interest rates low on the short end and also on the long end, to encourage spending, to encourage borrowing. And so it seems like with this growth we've seen that their policies are working. That said, we are starting to see a little bit of a slowdown. A GDP forecast for the next couple of quarters and going forward, we see some coming down off of that 6% growth, getting more back to where we were pre-pandemic, which was around 2.5 or 3% annual growth rate. In the labor market, we also saw a bit of a slowdown in August and September with the number of jobs added. The unemployment rate is at 4.8%, so getting back to close to where we were pre-pandemic, close to what the Fed considers full employment. That said, there is still about 5 million fewer workers now than there were before the pandemic. And then I'm sure I don't have to tell you, because it's certainly been in the news a lot, inflation is rising. After having inflation run below the Fed's 2% target for at least a decade, maybe a little bit longer, the past several months we have seen inflation levels between about 4 to 6%, so on the rise there. I mentioned the Fed has been accommodative with their policies, but they have recently begun talking of reducing some of their support, starting with those asset purchases. So we expect that by the end of the year, they will begin tapering their asset purchases, and they said they expect to have that program wrapped up by the middle of 2022. And then many are expecting the first Fed funds rate hike to begin in 2022, likely toward the end of 2022. And that really brings us to interest rates. So interest rates across the yield curve, from 0 out to 30 years, remain historically low. However, we are starting to see some upward movement. And if you want to turn to the next page, I'll talk a little bit more about interest rates. So the chart on the left here shows the U.S. Treasury yield curve at 3 points in time. So that dotted blue line to the solid blue line, that's your year-over-year change. So September of last year to September 30th of this year. So you can see interest rates have moved up a bit. When you move past 1 year, we started to see interest rates move higher. Then on that longer end, moving up somewhat because of those higher inflation expectations. Although I think you would likely see interest rates a bit higher if you thought inflation was going to stay at these 5% levels for some time. But still, rates are moving higher. However, you can see on that very short end, rates didn't really move at all. In fact, they moved slightly lower. Those rates have really been anchored down by that Fed funds target rate at 0%. Also on this chart, you can see where interest rates were in December of 2019. So showing you just a point before the pandemic, before the Fed cut rates to 0, before rates fell. So you can see we are still below where we were before the Fed cut rates, even though rates have moved higher. And then the chart on the right-hand side is just the 2-year U.S. Treasury yield over the past several years. Again, just to give you a sense of what interest rates have been doing. So that sharp drop is when the Fed, again, cut their target rate down to 0. That really has a big impact on those shorter term interest rates. And then it really stuck there. It remained around 0.2%, which again is very, very low for a 2-year security. It remained there for about a year or even longer. And then if you look on the right-hand side, you can see that we are starting to see that tick a little bit higher. And since the end of the quarter, since the end of September 30th, the 2 years moved up even more. Again, on the expectation that the Fed might raise that Fed funds target rate toward the end of 2022. And the 2-year today is up to 0.45%. So it's definitely on some upward movement here the last couple of weeks. If you want to turn to the next page, we'll look at the city's portfolio. So here is a snapshot of the city's portfolio on September 30th. This includes the funds that are managed by PFM. Most of those funds, at $193 million, most of those are invested into a longer term 1 to 5 year portfolio. And then a small allocation is in a bond proceeds portfolio. The PFM managed funds have a yield at cost of 1.47% at the end of September 30th, with an average maturity of just over 2 years, and then very high credit quality with an average credit quality of AA. The city also maintains funds out of PFM's management in overnight liquid accounts, including the Oregon Short-Term Fund, a local government investment pool managed by the state, as well as at a bank. The city is earning a very favorable rate on those funds, considering they are accessible overnight. So that's been a good option. And PFM and city staff does stay in contact to ensure a good allocation, the optimal allocation between invested funds and liquid funds, to ensure that your liquidity needs can be met. You can also invest funds longer for long-term growth.
Excuse
And
me,
then
Allison. Allison? Thanks. And if any other, I presume it's okay to interrupt your presentation with questions?
Oh, yes, please.
Okay, so that's, hope the other members heard that. I think now I know what LIGP, that acronym is local income government, correct? So that's the stuff you're talking about that we have invested here and we can get to it anytime we want.
Yeah, it stands for Local Government Investment Pool, and the specific pool is the Oregon Short-Term Fund. So that's correct.
Got it. Okay, I understand it. Thanks. I had that as a question. I found my printed material now and I've got some questions on them, so good.
Oh, yeah. Yeah, and I know, please interrupt if there's any questions. So looking at the chart on the upper right-hand corner, it shows you the sector allocation, how the funds are invested. So you see those liquid accounts in orange and green, and then the remainder are the PFM managed funds, so invested in U.S. Treasuries, federal agencies, and high-quality corporate notes with maturities from less than 1 out to 5 years. So a pretty well diversified portfolio. PFM does look for opportunities to safely look for ways for the city to, again, safely increase your investment earnings and return. The U.S. Treasury and federal agencies, of course, are your safest investments. They also, offer yields that are lower than corporate notes, but we are being fairly more conservative than we normally are in the corporate note sector because interest rates between the different sectors have been quite narrow. So you don't get a lot of additional yield from corporates, not the yield we think you should get for taking on that interest rate risk. And so we do see, maybe a bit less, fewer corporates than we would normally have. Your policy and state statutes allow for 35%. Not that we would get that high, but there is limited opportunity now as we, seek to put safety and liquidity first.
Excuse me, Allison. Allison, I got another one. Sorry. It's not like I can raise my hand and you can see me. We're going to get talking later about ESG, and I presume that the only space we have to practice the principles of ESG would be in the corporate 12%.
Yeah, and Dave will talk more, and Dave, you can correct me now if I'm wrong. Some of the federal agencies do have ESG scores, but they're pretty good scores. When you talk about ESG and what you want to target, I'd imagine all the federal agencies fall into that category. So yes, it would be the corporate.
Especially under this administration. You don't have to answer that. That's a political comment.
No, Allison's right, Councilman. Our ESG approach does primarily focus on applying ESG to the corporate space. But as Allison mentioned, we do have risk assessments for many other types of issuers that we invest in on behalf of our clients, including federal agency debt and some other organizations that are called supranationals or U.S. instrumentalities. These are organizations like the World Bank and other kind of multinational type organizations. ESG, I would also just mention quickly that ESG risk assessments are expanding. There are systems out there, including from our third-party provider, that even evaluate U.S. Treasuries and other sovereign debt. And you're starting to see a focus in the muni space as well.
Thanks.
If we want to turn to the next page, we'll look at the portfolio performance. So we do measure performance on the city's long-term portfolio. It's measured against a benchmark. The performance benchmark, which is noted in the footnote, is currently the 1 to 5 year U.S. Treasury index. And then we show performance on a total return basis. So that takes into account both your realized earnings, interest earnings, any gains or losses on sales. It also takes into account unrealized earnings, so changes in market value due to changes in interest rates. And so for the past quarter and the past year, total returns have been quite low, you can see, for both the portfolio and the benchmark, even slightly negative for the past year. And a negative total return means that your unrealized losses were greater than your realized earnings. So on a market value basis, you had losses in the portfolio. You do always, of course, have realized earnings. And that's a result of interest rates moving higher, especially recently, as we saw. So that has negatively impacted the market value of your current holdings. Of course, the good thing about rising interest rates is you can purchase higher yields going forward, but you do see that impacted in the total return. You can see even for the past year and the past quarter where returns are low, and you did outperform your benchmark by a pretty wide margin, especially for the past year. And that's a lot of that has to do with the diversification of the portfolio, that allocation to corporates and even federal agencies, which have performed better than U.S. Treasuries. Also somewhat of the duration or the average maturity of the portfolio when rates are moving higher, to have a bit of a shorter duration relative to the benchmark benefits the portfolio. So those two reasons the portfolio did outperform your benchmark for the past quarter and the past year. Then since inception, you can see the portfolio has done well, earning 1.44% per year on average, and then outperforming your benchmark by 0.18%. And then the next page is the outlook. If there's any questions on return, I know total return performance isn't always something people are used to seeing, so if there's any questions there. So just briefly on our outlook, I mentioned, the U.S. economy does continue to do well. The recovery continues, but it is a bit more fragile. It has slowed down a little bit. We do expect to see GDP slow a little bit, but to still, show growth, above what we saw pre-pandemic. And the consumer really continues to drive this. A lot of pent-up demand from last year. A lot of people have more money as a result of stimulus checks, and so spending has been quite strong. I mentioned we are seeing interest rates moving higher, so this is great. It does create opportunities to add new investments to the portfolio at higher yields than we could purchase them last year. Although, as I mentioned earlier, that does mean it could negatively impact the total return of the portfolio. So we may see a few quarters where we do have quite low total returns, but hopefully we'll continue to outperform the benchmark and then move through this cycle and continue to add value, higher earnings, higher return to the portfolio. We continue to see broad diversification, not only by sector, but also industry and issuer. We think this adds to the safety as well as the performance of the portfolio. And then finally, again, the highlight of safety. Safety is the #1 objective. It always is. and especially in this interest rate environment with a lot of uncertainty, interest rates moving higher, safety remains the #1 priority. And that's the end of the piece on the portfolio. In your agenda packet further on, you do have the full quarterly report, which contains a lot of additional detail on the portfolio, the holdings in the portfolio, transactions. But that's the end of the presentation on that. But again, if there's any other questions for Lauren, Dave, or myself.
Anyone have any questions? I've already asked mine.
No questions from Jose.
Okay, thanks, Jose. Okay, we're moving on to the ESG portion.
Okay, great. So as Jenny mentioned earlier, we were certainly aware that you folks are talking about and thinking about a sustainable investment approach and potentially ESG in particular. And so we did have a good conversation with Josh and Jenny and Kelly and Anya about 2 weeks ago about PFM's approach and how we think about ESG and how the city's portfolio looks like from an ESG perspective and so forth. And in fact, there's some data and analytics included in I think the appendix of your package with regard to our evaluation of this city's portfolio from an ESG perspective, which I'm happy to answer questions about and talk about further if you'd like me to do so. But I think a good place to start is just to kind of talk about what is ESG investing exactly. When we think about ESG investing and talk to folks about it, what we're talking about is an approach that really broadens the investment analysis. So it's instead of being sort of taking the traditional approach that is just focused on traditional financial factors, it also takes into account environmental, social, and governance, risk metrics and risk factors. The focus is really on analyzing and assessing the ESG risk exposure of an organization and how effectively that organization is managing that ESG risk exposure. And the risks that I'm talking about are what are deemed to be material or significant ESG risks. These are risks that if they're not effectively managed could have a significant either negative impact or potentially a positive impact on a company's value and performance over time. And these risks, they vary by company, and they're primarily driven by a company's business activities. So for the most part, when ESG data and analytics providers and the investment community in general evaluates ESG risk, the place they typically start is at kind of the industry level, because usually companies within a particular industry share fairly common or similar ESG types of risks. So just to give you an example, as you would imagine, an oil and gas company has a much higher level of environmental risks and a much more significant impact on climate change type activities and so forth through greenhouse gas emissions than a financial services company, which really doesn't have much of any type of environmental impact, but tends to have higher levels of social and governance related risks. So you kind of have to keep in mind that these risks do vary by company, which creates sort of the challenge of how you sort of evaluate these risks using some sort of common methodology. So if we go to the next page, I'd like to just spend a couple minutes talking about our approach to ESG investing. And let me just start by saying, many clients that we talk to about an ESG approach are kind of interested and want to move in this direction, but they're not really sure how to go about it. And further, ESG means something different to everybody. What every person on this call might think of ESG may differ from what I think ESG is, for example. So we recognize that challenge. And we really got focused on ESG a few years ago when we were working with the city of Boston on developing an ESG approach for a portion of their fixed income portfolio. But we designed that approach in a way that it could be more broadly applied to any organization that we work work with that has interest in employing an ESG strategy through a separate account. So the approach that we've designed, as indicated on this page, is customizable and flexible, and it's really kind of consistent with the way we manage portfolios, in that we're really designing the approach based on our clients' unique sustainable investment objectives. We're here to understand how our client thinks about ESG and what their sustainable objectives are, and then work with them to develop potential options to help them achieve those goals. Again, we're not here to sort of define ESG on behalf of our clients, but rather understand how they want to define it and how they want to implement it from an investment perspective. We of course are not ESG data and analytics experts. It's a very specialized area. We recognized that we needed to we needed to identify a partner, if you will, a third-party provider that could offer us a rich data set and methodology that we could leverage for this purpose. So we ultimately evaluated our options and selected a company called Sustainalytics. Sustainalytics is a Morningstar subsidiary. They're a global company. They've been in this space for over 25 years. They have a very kind of robust data set that includes ESG evaluations on something like 14,000 issuers, and they've developed a very sophisticated but very kind of user-friendly, to some extent from my perspective, approach that enables us to evaluate the kind of the absolute ESG risk that an organization is exposed to, and it provides for comparisons across industries, even though the companies in those various industries are subject to different types of material ESG risks. So if we could go to the next slide, I'd like to just spend a minute talking about some of the advantages of this solution. We talked a little bit about the flexibility and customization aspects of it, which we think offer a great advantage to the folks we work with on implementing this approach. But the other things I want to mention is that it's a transparent approach. And what I mean by that is, just to kind of repeat what I said earlier, we're not determining ESG on behalf of our clients, but we're working with them to understand, how they want to define ESG and how they want to go about this, kind of within the context of the framework that I described. So the approach we're taking is transparent in that everybody sort of understand what the rules are that we're using to implement ESG on their behalf. It's a rules-based approach or an objective approach, and the advantage to that approach is that it really eliminates some of the questions and ambiguity that can arise when you're sort of taking a less defined approach. In other words, it's not just sort of this sort of an approach where the manager's saying, well, that feels like it's ESG friendly and that doesn't feel like it's ESG friendly. And furthermore, it eliminates questions about the methodology. It's not this kind of opaque black box system that we're using where we're not spending any time explaining or educating on how it's being employed on behalf of our clients. Quite the opposite. We spend a lot of time educating our clients on how to better understand the ESG level of information, the metrics, and reporting that we're delivering on a quarterly basis, so that you continue to learn with us and remain informed about how things are going, and then have the ability to determine whether or not it makes sense to kind of change the approach that's being taken. So I'll pause there and see if there are any questions.
I have a comment, Dave, and that is that one of the things that I'm very interested in is you've already discussed, and I like it, that is transparency concerning the methodology, because I'm sure that even somebody hearing about this is going to say, oh, those people on the city council, they're trying to advance their social goals and just picking what they like, just like you said. And I don't think we ought to do that at all. And as long as I'm commenting, I will tell you that one of those earlier slides that had, I can back up, I think the 4 or 5 pictures, and they all fit. Yeah, it's the 3 environmental, social, governance, especially environmental and social. Those fit exactly what we've been doing as a council. We've got a climate action plan, and that relates to all one of those: climate action, air pollution, deforestation, weather pollution. We have also adopted looking at everything through a diversity, equity, and inclusion lens. And we also have condemned white supremacy, supported DACA dreamers. That's the stance that the city council is taking. So, but I don't want anybody, nor do I want to do myself, to have us just jump off the deep end and invest in things that we cannot use this kind of analytical framework. So I'm very interested and impressed. While we break for comments, anybody else on the committee have comments? And I promise I won't probably say anything else, because we got to meet the counselors. We've got a meeting at 5:15 that I'm pretty much in charge of too. So we're going to run out of time. So go ahead but if anybody has any questions now or comments, please make them. Any member of the Finance Committee.
Thanks, Tom. I'll jump in. I was wondering if you mentioned that kind of our stats, or how our current situation is looking with these different things in mind. And that was later on in the agenda packet. But for those who are not city councilors or staff and who don't read this whole packet, can you give us just a really short synopsis on where we are as a city right now when it comes to ESG investing already? Because I know that there are companies that are out there that are doing the right thing, and they are strong companies for investing in already traditionally. So how are we doing right now? And then also, I second what Tom was saying about how this needs to be a strategic plan and not just dumping off the deep end. I agree with that, and I'm thankful for that type of leadership. So could you maybe speak to that question?
Sure. Thanks for the question. So, and thanks for advancing the presentation to that section here. So I mentioned that we leveraged the Sustainalytics platform and that platform provides a significant number of ESG risk metrics to evaluate issuers that are in the city's portfolio and in our clients' portfolios in general. The key risk metric that they have created is what is referred to as an ESG risk rating. It's not a credit rating, just to be clear, but it's kind of got some similarities to a credit rating in that it is on a scale. And that scale in this case is a 0 to 100 scale. And what can be a little bit confusing about how to interpret that score is that actually a lower score represents lower ESG risk. So you want a lower score as an issuer. That means you generally have lower ESG risk. So the risk rating categories range from negligible risk, which there are very few issuers that fall in that range, to severe risk, which there aren't a significant number of investment grade issuers that fall into that range either. Most issuers that we evaluate tend to fall in this kind of low to severe risk range, and for a variety of reasons. So we did look at the city's portfolio. As mentioned, the average risk rating for the city's portfolio as of September 30th, 2021, and again, this was just applied to the corporate issuers in the portfolio, was a medium risk level, which is pretty good overall. 80% of the issuers were in that negligible low to medium risk range. Again, that's a pretty good outcome. And about 20% were in the high and severe risk ranges for a variety of reasons. So overall, pretty good position at the moment. And I think that's in part driven by the fact that, we really carefully vet our approved issuer list that we ultimately invest our clients' funds in, and we do certainly take a look at governance as an aspect of that credit risk analysis. So we are sort of thinking about ESG at some level there as well. So it's kind of a good starting point. However, many of the folks we do talk to have similar results when they start, and then they kind of decide they want to, they want to improve on that from there by sort of incorporating some additional ESG investment parameters to help kind of, manage their overall ESG risk exposure.
I have a quick follow-up.
Mhm.
Would it be, I guess where my mind just went, I'll just talk because it's just me, would be to look at those severe, I guess, investments or the companies that landed in that severe category.
Mhm.
And how would somebody approach that? Like, what would be a really great way for the city to move forward in a steady, calm, well thought out process? Would it be to start with those companies there to find maybe different investments that maybe get the same outcomes, but with a lower risk for ESG on those extreme ones, so that we can overall reduce our goal to get to that low category as well? Would that be a wise move?
Well, generally, it's a great question. Generally, after we've worked through a process where the city has identified an approach they want to take, one of the questions that does come up is what you just asked, which is, okay, we're going to move forward with this approach. Do we apply it to existing holdings? I think is kind of what you're getting at, right? Do you immediately sell, for example, a security that no longer satisfies the city's ESG investment requirements? Generally, we advise against taking that action unless the organization we're working with has a strong conviction that that's what they want to do, and that's fine. We would generally advise to take a more gradual process, which over time will result in improving the ESG risk profile of the portfolio, but for some period of time does mean that the portfolio may continue to own certain securities that you would no longer invest in.
Dave, could you talk through really briefly what the next steps might look like for this group? As far as I think we didn't quite get there, but the policy considerations as picking an ESG level, and then if the committee wanted to entertain any industry or sub-industry exclusions.
I think a first step is just us reconvening and us getting a better idea as to what's important to the city from an ESG perspective. And then from there, we would come back to you with some ideas on ESG frameworks that the city could adopt and implement, and we would help you see what the impact would be on the city's universe of eligible investments, as well as the existing portfolio. So you can see what the effect's going to be. And generally, we find that it tends to be less significant, or actually more negligible than you would expect. But we think it's really important to kind of work through that process so that everybody understands exactly what they're agreeing to move forward with. And then once the city has decided the approach they want to take, then we would work with you to update and finalize the appropriate investment policy language. Okay. And of course, we would have to talk about amending the investment advisory agreement at some point as well, because there is an additional cost to implement an ESG approach. And then once kind of we're through all of those steps and we're ready to move forward, then we begin implementing ESG into the investment management process for the city's funds. And on a quarterly basis, when Lauren and Allison are talking about the quarterly investment report, and they may ask myself or my colleague Sarah to join, we would also discuss kind of the ESG performance and characteristics of the portfolio as well, because we will incorporate ESG specific reporting and monitoring into the process. It's not a set it and forget it approach by any means. It's quite the opposite. We are kind of actively managing the ESG aspects of the portfolio, just like we would actively manage the portfolio itself from an investment perspective.
Jose or Trevor, do you have any questions? We're kind of getting into a pretty good free-form discussion here and haven't heard from either of you.
This is Jose, and Virginia asked my question and it was just answered. So it looks good and we're on the right track.
Okay, thanks. Trevor? Unmute, Trevor.
Yeah, sorry. Got my
That
video,
was a
not my
guess. That
sound.
was a guess, Trevor.
Yeah, no, you're correct. I clicked my video, not my sound. So I'm ready for page 40. I think it looks like the presentation will get more interesting when there's like a, conceptual placeholders for what's coming next.
Is that page 40 on our written materials?
I don't know. It's in the documents electronically, page 40. So we're getting close. Yeah.
Okay.
I think that's about where we left off.
Right. Are you talking about the example application? Am I on the right page, Councilman? Okay,
Yeah.
great. Yeah, this is just an illustrative example, just to be clear. This is not a recommendation by any means, just to kind of help everyone on the call here understand how we would apply the ESG investment parameters that the city adopts for purposes of determining issuer eligibility. So in this example, let's assume that the ESG investment parameters include 3 criteria, as indicated in the kind of the top right part of this page. The first is that eligible issuers have to have a medium or lower ESG risk rating. However, and many of our clients take this approach, there's an exception that allows issuers in the high risk category to be eligible, provided they are ranked in the top 25th percentile of their peer group or their sub-industry group.
So you're saying if they're the best of a bad lot, we still might do it.
Exactly. That's very well put, Councilman. Yes. Yes. I mean, generally, when we have looked at these companies, the majority of them seem to be committed to improving their ESG risk profiles, but they just happen to be in industries with higher levels of risk exposure. And it's very hard for them, for that reason, to achieve lower overall ESG risk scores. And then the third criteria in this example is simply an industry exclusion, which many of our clients, have a preference for also incorporating into their approach. And in this case, it's an exclusion of any industries that are defined as fossil fuel industries. So you can see how we're applying that criteria to, Apple, Chevron, and Amazon. Obviously Chevron's a fossil fuel company. They're an oil and gas producer. So they're automatically disqualified from inclusion for that reason. In addition, they are in the severe risk rating category as well, so they wouldn't meet the risk rating requirement either. Apple has a low ESG risk rating, low overall ESG risk exposure. They do rate well within their sub-industry as well. So they kind of tick off all the boxes there. So they, of course, would be eligible. Amazon tends to teeter between the medium and high risk ranges, depending on what point in time their rating is updated. They tend to get dinged to some extent for their performance in the governance category. And in general, and this has been pretty consistent with Amazon, and I'm not picking on Amazon. I probably have more Amazon boxes coming to my house on a regular basis than a lot of people. But they tend to rate poorly within their peer group. You can see in this 97th percentile. That means they're at the bottom of the list, essentially. So they wouldn't be eligible either. So,
Dave, do you, and I'm thinking Amazon, because I've been out there to see their plant, and I'm sure you have no dystopian ratings, but they would certainly fit that. Do you have anything about how the company treats its employees?
So that kind of analysis and criteria, Councilman, would be incorporated into the overall ESG analysis in the category of human capital management.
Okay, good.
Yes. So that would fall under the S category. Absolutely. Yeah. And that is something that gets pretty heavily scrutinized for a company like Amazon, but it does for virtually every company.
Yeah, okay.
I had a quick question. How many fossil fuel industry companies do we have investments in right now? Do you know? Sorry.
I'm not sure. Alice, maybe Ginny, if you continue
Yeah,
page
right
back
now,
to the
you
appendix.
have a small allocation to Chevron.
Okay.
That's one I say just get rid of. Forget the gradual process. That's just my opinion. We haven't adopted that as a policy yet, but that's where I would be going on all fossil fuel things, seeing as how I am on the Climate Action Committee. And, we've got goals of greenhouse gas reduction, and 53% of our emissions come from transportation, and most of that is from single occupancy cars.
And then
Sorry.
Dave, if I could just have a follow-up on that comment. So I can't imagine we're the first municipality to do this. And I mean, are there lessons to learn from other places that have done this? I mean, I assume there are other municipalities that have already excluded things like fossil fuels. So again, I think none of us want to do this in a brash way. We want to do it systematically and a coordinated process.
Yeah, it's a good question. And many of our clients have excluded fossil fuels from their criteria. A few have not. I wouldn't say that I've seen any approaches taken to date where the client has said, boy, I really just don't like this approach. We need to completely change direction. And, I would share something in that area if I had something to offer. The one thing I would mention is that, and this kind of goes back to the flexibility aspect of the approach. When we were working with the city of Boston, they initially excluded pharmaceuticals from their eligibility list because at the time they were involved in some lawsuits with some pharmaceutical companies over the opioid crisis, and they got past that process. They settled lawsuits, and they got comfortable with investing in pharmaceuticals again. So we made a change where pharmaceuticals were no longer excluded. However, they did decide to exclude some other industries. So again, it was just kind of a shift, but not a significant shift. So that could potentially happen for you folks as well. You may decide, oh, geez, we don't really want to, employ these specific metrics as thresholds anymore, or we want to reduce or expand the exclusions list.
Dave, I think that Josh was trying to anticipate this because we're running out of time here, and clearly we could spend a lot of time with you. So I'm looking to you and the other folks at PMF, as well as to Josh, and say, what are the next steps we're going to take? And I will tell you that all these things are diagrams that you've sent us are things that I'd be very interested in continuing a discussion after we have all had some further conversation about it and further review as individual counselors. So I'm looking at the PMF folks as well as Josh to say, where do we move forward here? Because I think we really, if we got 10 more minutes here, that's quite a bit, I would say.
If I may, and just to clarify what the process will look like. So this committee, you can recommend a policy change, and then it goes to council for adoption. So what I would recommend, if you guys are interested in pursuing this further, is that we have it as an agenda item at possibly a longer meeting with some longer time to really talk through what it looks like, what kind of recommendation you'd like to put forward to the full council. And there are some other time constraints there, but we can talk about that more at that meeting if that's what you guys would like to do.
What's the will of the rest of the group?
Yeah, I mean, I'm interested in this. I mean, I think that it's timely. I would like to move in this direction.
Okay, Jose?
Same.
Okay, Virginia?
Yes, I'm with you.
Okay, so it seems to me that our next step ought to be a longer meeting with mostly on ESG as opposed to the other investment, I mean, and that sort of stuff. I think we've got good advisors. We trust them. We trust the staff, and I'm not going to talk about whether the curve is rising or lowering or what it looks like. That's your responsibility. But where we invest and how we invest it, that's something that is the responsibility of the electeds in this group, and then the electeds as the counselor. So, Josh, would there be anything else that you would need to bring to us by way of any kind of potential recommendations? I mean, I'm pretty sure that you guys are tuned in to the views of the majority of the council on this stuff. And so we might want some sort of more specific recommendation on the from PFM and also from Dave on about ESG and where we could go and what are potential options. Because it sure seems to me that at least the four of us on this subcommittee are very interested in pursuing this, but we are interested in pursuing it in an orderly, open and comprehensive fashion.
Sounds good. I think we can bring back some options for you to consider, so you're not starting with nothing.
Okay. And don't bother to bring back the option of do nothing.
Okay.
So is there something else? I mean, we've got a few minutes. Is there anything else that Dave, you, or Lauren or Allison or anybody from PFM wants to add to this discussion?
The only thing, Mr. Chair, that I would add.
Whoa, you're here. You're here.
I made it. Thank goodness for technology.
Yeah, maybe you have a teenager or younger if you're working from home who could help you.
My 9-year-old, and yes, he is very, very helpful and savvy with it. So I'm very grateful for him. The only thing I would mention would be unrelated to the ESG is Jenny had talked about earlier in the packet starting on page 7 of the packet. We did make some very modest investment policy changes, really to align the city's investment policy with statutes. That's ORS 294-035, which govern the investment of public funds in Oregon. So there.
Wait a minute. We have to follow the law?
I know. Yes. So we've made some updates. They're not material changes. If they were, we would actually have gone to the Oregon Short-Term Fund Board first to get to a review by them, but these are not material. They're really, again, to align the policy with the statutes. But I did want to bring that to your attention because that was part of the informational items.
Well, thank you very much for doing that. And this is exactly the thing that I think we as counselors trust the staff. And if the staff has trust in the PFM, then, we're happy with that. And we expect you'll be doing the right things to keep us in compliance with the law and with good financial practices, whichever way we say we want you to look at the investments that we want you to make.
Correct. Yes.
Does anybody else on the committee have anything they want to say before I move to the rest of the agenda items? Okay, what about staff? Josh, anything else you want to add that we haven't talked about, or Jenny?
No, I think we're okay. Thank you very much.
Okay, Jenny? How does this all look from a CPA's perspective?
Sounds great.
Okay, so then I will move on to item number 6, and I look forward to meeting with all of you again so we can really get down to these discussions, and whatever additional material you want to send us, fantastic. Is there any continued business? That's a no. Let the record reflect that Mr. Eggleston is shaking his head side to side. Is there any new business? That's another no. Anybody have anything else for the good of the subcommittee before we adjourn? Okay. Yes, Jenny?
I think we wanted to confirm the next scheduled meeting date. It falls on the week of Thanksgiving, so we weren't sure if that would be appropriate timing.
Let me, my calendar is in my phone and my phone is being charged. Let me go get that so we can look at it.
That'll be the 22nd for everybody, November.
And Mr. Chair, we could look for an alternate time where we could have a longer period to talk about the investment policy, if that works.
Yeah, we definitely need a longer period. You know, we got a very good start. Oh, here's my phone right underneath my computer screen. We definitely got a very good start, and I really appreciate the information that you all are giving us. And let's, what would be the actual meeting? Were we not talking about Thanksgiving?
November 22nd would be the next regular Finance Committee meeting prior to that council meeting.
Well, shoot, that's Monday and Thanksgiving's on Thursday. Even those of us who are having dozens of people for Thanksgiving can do that. Does anybody, any of the other three have any concerns or problems with meeting on the November 22nd?
This is Jose. No, none on my end.
Okay. And I'm looking at the other two who are on the screen who are shaking their head side to side. And I
Not
think
related to the holiday weekend, but just
Pardon me?
I work a late shift that the Sunday and before, but I can be available at 4. I'd struggle to make anything before 2.
okay, well, yeah, I don't want to either.
Yeah.
But we need a longer meeting. That's the problem. Could we do it at 3:30? Would that give us enough time?
I think the big question there would be Lauren and Dave, if you guys want to be a part of it, if you're available also. Discussion.
Yep, I'm available on the 22nd. That works for me.
I'm available that date as well if needed.
Excellent.
Okay, and Trevor, could you make 3:30 that, and I don't know what the council, I don't know if the council meeting, you know, if we have like now we've got a work session at 5:15. Normally we don't meet till 6 o'clock. So that gives us a little more room. And I don't know what it's like that meeting.
3 or 3:30 should be fine.
Okay. So let's go this way, Josh. If we are going to have a work session or an executive session before the regular council meeting, let's go at 3. If the regular council meeting at 6 is where we're going, then let's go at 3:30.
Sounds good.
Okay, and whatever material you would like to give us, especially with you know, it looks like we have a pretty unanimous view on this committee that we want to move forward with the ESG and we want to do it in a deliberate. Listen, my father's a Presbyterian minister, and the way Presbyterians do things is decently and in order, and that's what we want to do for this.
Okay.
Any other comments?